Stock Compounders, Brad here. So Mohnish Pabrai just released a new interview, Q&A, with the students of the Rotman School of Management. Okay, this took place just over a month ago on March 3rd, 2023. And of course, I wanted to share my highlights from this talk from Mohnish Pabrai. So right off the bat, he gets into Warren Buffett's Berkshire Hathaway letter to shareholders. And he points out a few things that he really wants to instill in the minds of the students. So from Buffett's letter, over the years, I have made many mistakes. Okay, this is Warren Buffett talking. In 58 years of Berkshire Hathaway management, most of my capital allocation decisions have been no better than so-so. Okay, this is perhaps the greatest capital allocator of all time. So there's a really important lesson in here. He says, our satisfactory results have been the product of about a dozen truly good decisions, okay, about one every 5 years. And Pabrai took this a little bit deeper. So Pabrai has studied Berkshire in depth, and he points out Berkshire has bought around 80 businesses as complete acquisitions. Okay, they're under the Berkshire Hathaway umbrella. They've invested in around 120 stocks. Now, some of this was just to make the numbers nice, but give or take 120 stocks where Berkshire has been partial owners. So these are stocks that are tradable, publicly tradable in the markets. So that's 200 decisions over nearly 60 years. Okay, and only 12 are responsible for most of the outcome of the great track record of Berkshire Hathaway. 12 out of 200. Okay. Now, Buffett has compounded just shy of 20% over those 58 years, and that's double what the S&P has returned to investors. So it's interesting. If you double the rate of return over that period of time, the difference is 152x, okay? An investor in the S&P, what you'd end up with after 58 years versus what you'd end up with if you had bought Berkshire Hathaway 58 years ago is 152x difference, okay? 152x more for Berkshire Hathaway investors. So, if you can get any edge over the market for that length of time, nearly 6 decades, the result is incredible, right? There's a huge difference. And this isn't something that the human mind is very good at working out, right? We're not very good at doing this math in our heads, this kind of math of compounding. Now, Buffett points out, even with all the mistakes, right? The reason the overall results were incredible is that the flowers were never cut and the weeds were never watered. Okay, I believe that's a Peter Lynch expression, right? Don't cut the flowers to water the weeds. 12, what does he say? 12 not satisfactory. 12 good decisions, truly good decisions out of 200, okay? It's not about the decisions that weren't good, even though that was the vast majority, right? It was really just about those 12 truly good decisions. That 5-ish% of decisions were what made the difference. He talks about Walmart as part of the Nifty 50. Now, Chris Bloomstrand, in his annual letter, which is incredible. I encourage you all to go out and read it, especially if you're interested in Berkshire Hathaway, because Bloomstrand always does a really incredible breakdown of what he thinks the intrinsic value of Berkshire Hathaway is. But Chris Bloomstrand never talked about Walmart. And, Pabrai's thinking, okay, you could have made a case that Walmart was part of the Nifty 50. Now, if that was true, and you bought Walmart as part of the Nifty 50 back in the early 1970s, and the other 49 bets went to zero, Okay, so Walmart was the only thing that's not zero in the portfolio. You still trounced the S&P 500, okay, with 1 out of 50 bets, the rest going to zero. That's the power of one of these great long-term incredible businesses, right, like Walmart. You still trounced the S&P over those 50 years by some 4% per year, right? So say it's 9 or 10% from the S&P. If you just owned Walmart as a 50th of the portfolio and held it, you've got an alpha, right? An outperformance of 4%. So you light fire to 98 of $100, right? And that $2 in Walmart beats the pants off the S&P. And that's, Pabrai says, that data is in sync with Buffett's record, okay? Some of these investments he made are like holding Walmart for 50 years. So it's a really important lesson to drill in for long-term investors, that it's not about the mistakes, right? Don't fret too much about the mistakes. All investors are going to make mistakes, even if they do an incredible job of analyzing a business, right? Things come out of left field in the world of investing. Pabrai says investing is a very forgiving business. You could have been wrong on 49 of the 50 Nifty 50 stocks and still done very well. You wouldn't have done well by dancing in and out of Walmart, right? So if you're, looking at these quarterly earnings updates and Walmart is down a quarter, right? From the perspective of Pabrai and Buffett, that's noise, okay? But a lot of investors pay attention to that, and that can cause investors to kind of jump in and out of the stock. And that's not going to get you to the promised land. Okay? That's not going to get you that outperformance over 50, 60 years, the same way that just holding Walmart would have done. He says nobody held Walmart stock for the last 50 years except the Walton family. I will mention, I think I saw recently that the Walton family has started to kind of unload some of those Walmart shares. So, it's hard to hold something forever, right? The key with investing is not to avoid mistakes, right? We are destined to make a ton of mistakes. The concept that matters a lot is the concept of circling your wagons, okay? And I'm not sure I fully grasped what Pabrai was talking about here, but I think what he was talking about is when you get a company that you've owned for a few years, right? You really understand the business because you've owned it, and you come to appreciate how incredible of a business it is. I think circling the wagons means that's the business in your sweet spot, right? Or the couple businesses that are really in your sweet spot. And those are the businesses you really need to allocate your resources to, right? You need to double down on those bets when it becomes clear that those are the high conviction, great long-term bets. Those should be central in the portfolio. So I think that's what he means by circling the wagons. He says we need 2 or 3 things for the inner circle, right? The companies in the portfolio that were really kind of core. Tremendous business with tremendous growth runway. It sounds like he was channeling his Donald Trump here a little bit. Tremendous. With very high returns on equity without undue leverage, right? Not too much leverage, which has the ability to reinvest capital at very high rates. Right, so there's growth opportunities in this business, and which has a very modest price. Okay? And that's the hardest piece. The last one is the most difficult, that modest price, because if you've got all of those other things, most of the time the market is going to see that as well, and it won't be a modest price. Right, the market knows this is an incredible business, and so they're going to bid it up. Of course, every once in a while, the market panics and there are opportunities to buy these great businesses at very modest prices. I think the angle that Pabrai is more interested in is finding these businesses before they're well recognized by the market as great businesses. So kind of early in the life cycle, like Races, for example, which Pabrai bought when Races was a 20 million market cap, right? He bought a third of the business. And it's done incredibly well since then. One of the hallmarks of a great business is durability. One of the issues with capitalism is if you have a great mousetrap, right? You've got a great business, you have a target on your back, right? It doesn't take a rocket scientist, it doesn't take incredibly brilliant entrepreneurs to identify that what you have is special. And of course, they want a piece of that, right? That's capitalism. And they're going to come after you and try to take market share from you, right? Try to take your customers away and participate in the incredible economics of whatever you've figured out. And they'll usually succeed, right? Great businesses don't tend to last that long. Pabrai likes to say, capitalism is creative destruction. So you're never safe. Even if you think, hey, this is the best business in the world, we can rest on our laurels. No. There's always the next thing coming along, right? The next disruption. Pabrai says, I don't think I could make a bet that any of the FANG stocks, right, the big U.S. tech companies, will still be thriving 40 years from now. Okay? Even though we look at Amazon, we look at Google, right? We look at Microsoft. I mean, it's hard to imagine, well, maybe not for Google, what's going to disrupt these companies, right? I'm speaking about ChatGPT, of course. But companies like Apple, they seem really entrenched, right? But that's always how it is. That was the narrative back in the early 1970s with the Nifty 50, right? They were such great businesses, you couldn't pay a price too high, right? There was no price too high, as Howard Marks likes to say. Well, most of those turned out to be terrible investments. If you were paying up, if you were paying prices that they were in the early 1970s. Back to Pabrai, the FANGs, maybe 10 years from now, yeah, they'll still be around, they'll still be going strong. 20 years from now, maybe. But this really just speaks to this headwind that every company has of capitalism, right? Creative destruction. Somebody's always going to be coming after you if you're doing really well. So on the one hand, you got to circle the wagons, right? You've got to make these high conviction bets core to your investment portfolio. On the other hand, everything will get taken out back and shot, right? This is businesses, there's parallels between biology and businesses. Everything dies, right? So you've just got to hold those two, right? And just figure out how to navigate that. It's difficult, right? Nobody says this game was easy. Charlie Munger says, why should it be easy to get rich? But you've got to separate the signal from the noise, right? When you've got these businesses in the portfolio, right? You have conviction that they're great businesses. It's easy to get distracted by the noise, right? And the noise can cause you to do something silly, like sell one of these great long-term compounders based on information, data, that's not material to the investment thesis, right? To the business, to the long-term viability of the business. So you've got to know what to pay attention to. And that's separating the signal from the noise. What is normal cyclicality and what is secular decline? Now, there's some prudent advice here from Pabrai. Err on the side of inactivity when it comes to selling, right? Make sure that what you own is actually in secular decline before you sell it, because it's easy to get confused between signal and noise. So just wait to be sure. If you're not sure, wait, okay? Do nothing. Something Terry Smith likes to, one of his kind of core investment tenets, do nothing. To gauge a management team, we simply look at the track record. Okay, all CEOs got to be CEOs because they're great salespeople. Okay, you can't rise in an organization to the level of CEO if you're not very charismatic, right? A great salesperson, optimistic even. Now, that's not necessarily the kind of person you want to be taking investment advice from. If you go meet a great salesperson, right, like any CEO is, and you talk to them about a topic where they know everything and you don't know very much, right, which is going to be the case if you're meeting with a CEO, and you rely on that information to make investment decisions, you will get to the poorhouse, okay? The way to look at a management team is to look at what they've done in the past. Right? That is the measure of a management team. So, some words of wisdom from Pabrai about how to suss out management. Talking about Pabrai's investment approach, what we want to do is anomaly-based investing. Okay, we want to invest in things which make no sense. This gets back to the investment in Rasis, the warehouse company in Turkey. It makes some sense, but when you talk about a company that's trading for 3% of liquidation value, okay, this isn't business value, right? This is liquidation value. That is an extreme dislocation. Okay, that doesn't make sense, even in the macroeconomic landscape of Turkey, where inflation just seems to be running away. So that's what really got Pabrai interested. Wow, this seems like it doesn't even make sense how cheap this thing is. Truth is stranger than fiction because fiction has to make sense. He's getting a little cheeky here. When things don't make sense, that's when we have a shot at greatness. Right? That's when we have a shot at one of these 100-baggers. Okay. So, then he talks about how Excel won't help you make sense of something that doesn't make sense. So, it's a little bit playful here. Obviously, you want to understand the things that you're investing in. But if you need Excel to kind of make the numbers barely make sense for it to be an investment, for Pabrai, that's a quick pass. You should be able to do the math in your head. And if it's not compelling enough to see that it's compelling, doing the math in your head, it's probably a pass. Last piece here on China, okay? He's asked about China. For me, China is a difficult place to invest. This is Pabrai's words. We only have one investment in China, a little bit of Alibaba, but that doesn't really count. It's barely anything. The investment in China is Prosus, which is really an investment in Tencent. He says, we still own it. Tencent is a very remarkable business. But there are aspects of that business which are difficult for someone like me to figure out. How the Chinese government thinks of them and all of that. Okay, obviously, whether the Chinese government thinks favorably of what you're doing versus kind of wants to penalize what a business in China is doing, there's a lot there that's kind of difficult to navigate for people who are living in the U.S. particularly. He also says it's a mega cap. Okay, it's hard to get a 100-bagger. You can't really expect to get a 100-bagger out of a mega cap. Pabrai really wants to focus on 100-baggers. Tencent has a $300 to $400 billion market cap. Last I checked, it's $465 billion. So to get 100x, we're looking at 45 to 50 trillion. Okay, there aren't any companies in the world that are that big. The closest thing is Apple, which is 2.6 trillion, okay, which is like 5% of the size. that Tencent would have to become in order to get a 100-bagger out of Tencent. So, that's a big strike against Tencent, in addition to it being in China and having to navigate the CCP. So the final point on Tencent from Pabrai: if I find something better, I will switch to it. Okay, so it sounds like Tencent or Prosus, which is a bet on Tencent, is kind of on the chopping block here. If Pabrai finds, a much smaller business that he thinks has a compelling runway and it has a modest price, I'm guessing Pabrai wouldn't hesitate too much at this point, switching funds from Prosus to that new bet. So that's where he's at on China and his Tencent investment. So that's it, guys. That was a lot to digest, but I'm so glad to see Pabrai is back on the Q&A train. Hopefully we're going to see I think last time he put a Q&A out, he did a couple in a week or something like that. So I'm hopeful we'll see a few more of these in the near future. But big shout out to Pabrai for really picking up the ethos from Ben Graham and Warren Buffett of giving back to the value investor community, kind of sharing what he's learned along the way. I find it very valuable. I'm sure many of you do as well. So big shout out to my man, Mohnish. All right, guys, that's all I got for today. Thanks for watching, and I'll see you all in the next one. Take care.